Well, our general strategy is to increasing quality. So we're always looking to exit our current deals and then buy more deals that are higher quality um, as we grow. Um, But yeah, as far as the market, it's hard to kind of predict the future and know like what inflation is going to be in the future, what cap rates are going to be like.
Right.
But I mean, you can take reasonable, educated guesses and plug them into your underwriting model, and then based on the information that you have and your continued due diligence on the property, come up with a range of outcomes, right? Like stress test it, come up with the worst case, and then like the medium case and the best case. And then if those range of outcomes are within your predetermined criteria of like what you're willing to accept, then you do the deal. And so you can apply that to any point in the market. And you know, like if it's a buyer's market, then it's going to be easier to buy but hard to sell, and then vice versa. So you know, like there's always going to be fluctuations in the cycles, but pretty much in any market, you can always be doing something productive. You know, as long as you are disciplined.
How are you using the changing in interest rates through your stress test?
Well, we prefer to go for fixed debt. So
No,
you know,
that's not it. No, that's how you're buying the property. But when you're projecting out what it's going to be like 3 to 5 years from now in this higher interest rate environment, how are you using that information in your analysis?
Oh yeah, so we have a stress test where we shock the both the operational NOI by decreasing it by a certain percentage, and also to check if it's possible to refinance, like say out of short-term debt, if the rates go up. So we have stress tests in our model that kind of build in those events.
Okay.
So if it passes those tests, then we'll do the deal. If it doesn't, then you know we back off.
What type of increase in interest rates are you using in your analysis?
On that one,
up to like 2 points, like 2 points even.
Well, like 25%.
Wow. Yeah, I mean, if they're talking about going up a quarter point twice a year for the next 2 years, you know, we're looking at least and I think that's being too conservative. I think it's going to be more than that, because I think inflation is a lot uglier than people are making it out to be. But yeah, I mean, you got to like show it at least a point. What happens? Because you always have to think about the end game and your customers. Who are your customers going to be? 3 to 5 years from now. Your customers are going to be the people buying your property, and their cost of business is going to be a lot higher. And how is that going to impact you?